Good morning once again, and welcome to the Haven Financial Group radio show. I'm Larry Kolvig, founder and CEO of the Haven Financial Group. On today with Kyle Thomas, a certified financial planner on the Haven investment team, talking about bonds and retirement strategies, all this really, really exciting stuff, and maybe not so exciting, but if you do get excited about it, again, feel free to give us a call. We'd love to visit more with you.
That number is 612-504-8400. We want to talk about conservative investing in this economic environment. Kyle, I'm going to start with you, and I'm going to have you sort of walk through what you envision or what Haven Financial Group envisions as conservative investing.
Well, yeah, in simple terms, conservative investing, people generally think of more bonds, cash, maybe fixed annuity type investments. Mm-hmm. For us, it goes a little deeper, though. For us, it means having a diversified portfolio, mitigating your risk, and making sure that you have buckets across all these different categories, because when one of them, tips over, then all the other ones can remain unaffected. Whereas if you have, just maybe 2 or 3 buckets, being used as your investments, if one of them tips over, that can be a big percentage of what you have, right? So we just want to make sure that we are diversified and taking the right amount of risk. Mm-hmm. And one thing that I like to say for people is, you take risks every single day. When you go into your car, you're taking a calculated risk that something's probably not going to happen, right? Well, a lot of people take a risk by not investing their investments. They're sitting in cash. It's at the bank, or it's in, a money market fund that's getting, 2 to 3%, somewhere in there. But that you're not taking market risk when you're in that. Absolutely. I 100% agree. But you're taking on a different type of risk. You're taking on purchasing power risk. Mm. And you're actually losing money, especially in these last few years, because inflation has been, topped out close to 9%, and it's still actually fairly high year over year. It's about 2.6 for this last month, I believe. So that's something that you have to keep in mind, too, is if you're not taking stock market risk, what kind of risk are you taking? Mm. And it's important to make sure that you review that with a professional and make sure that you're properly allocated.
Absolutely. Yeah. You've got to take into account inflation, obviously, and healthcare costs and those kinds of things that just continue to go up. Let's talk about understanding sequence of returns risk.
Yeah. Sequence of returns risk is a huge deal as well. Having some negative returns in those first couple of years of retirement can deeply impact your portfolio for the rest of your retirement. And that's actually something that we plan for in our meetings. We have 1,000 different trials run in our Monte Carlo simulations, and we actually have a bad timing scenario. And that bad timing scenario is exactly that, negative returns in the first 2 years. Mm-hmm. And when we look at that, we're not planning for that as our base case, but it's definitely something that we keep in mind and show the clients to make sure that, hey, if this happens, are we going to be okay? And how many failures in our 1,000 trials do we have? So the sequence of returns can really play a role, and on the vice versa. If you have really positive returns in your first couple of years of retirement, mm-hmm. it could set you up for the rest of your time. So it's important to make sure that we're planning for sequences, not just a static 6% return every single year, because that never happens.
Sure.
It's going to have variations. We're going to have negative years. We're going to have positive years. And the negative years seem to happen, in 1 out of every 3 or somewhere, some kind of variation in there. But go ahead.
No. Go ahead. You finish your thought.
I was going to say there was someone that I met with last week, actually, and they were in all cash. And I ran these Monte Carlo simulations for them. In their current scenario with all cash, they were at a 0% success rate. I reran it for them, investing at 70% stocks and 30% bonds. And they went to a 99. You can't get 100. So it was essentially as high as you can be. So it just shows you that, rebalancing, taking on some risk, is actually good for you
Mhm.
because it diversifies more for you.
Well, so
Kim,
let me.
if I could add to that, if you don't mind,
Sure.
if listeners are listening in and tuning in on this segment and they say conservative investing, I don't want conservative investing. I'm a risk taker. Don't get the wrong mindset here. It's not just a mindset; it's a strategy. And yes, at Haven Financial Group, as we work with those close to retirement or in retirement, or younger ones too. But if you're in that age group, people do tend to take the foot off the gas pedal a little bit for risk. So
Mhm.
we do see things through the lens of retirement. Granted, our clients that are 20 or 30 or 40 years old, that retirement, the element of time is completely different. But as people do get older, what do they say? Offense is great, but defense wins championships. So what a lot of people we come in contact with are not aware of is how much risk they are taking. And they only notice it when the times get really tough, and then they push the panic button. And then we're trying to help them not make decisions that are not good decisions at that point. So don't just think conservatives, oh, I'm going to put it in the mattress, I'm going to put it all in cash. No, what we want is you to have a real good balanced portfolio. And you've heard me say this, a bucket full of liquidity, which most people don't have enough of, cash that's readily available, monies that are in the stock market, properly invested, and perhaps some investments that offer principal protection without the risk of the market, and also making sure we keep fees to as low as possible.
Mhm.
That's what we're trying folks to have a good understanding, and that's what will give folks peace of mind when the market is rocky, which we've seen over the last year or 2 years.
Well, Larry, you just talked about some of those buckets, and earlier Kyle talked about the idea of having monies invested in stocks and in bonds. Are there other tools out there for conservative investors?
Yeah, there are a few other tools out there, and one of them that we really like right now is in a fixed index annuity. Especially, there's some out there that have really great guaranteed interest rates. Right now, there's a 8% one, and that is something that we've allocated a lot of funds to in this past year and a half, because starting out with 8%. The compounding interest on that for those remaining years can be so valuable to you, because you say you start out with 100,000 in it. Well, that second year you're starting out with 108,000, and so that compounding interest really takes a big impact, and it's guaranteed with no downside. So if we can get 8% with no downside, I'll take that every day.
All right. So, Kyle, tell us about some of the common misconceptions when it comes to conservative investing.
Some misconceptions is, that you're not going to lose. That's the biggest one. And yes, we do not want to lose. Actually, when we're investing for you, we're trying not to lose more than we are trying to actually gain. So we are in alignment with folks who don't want to lose. But in a sense, you are losing if you say you are all cash, because that inflation rate. If inflation is higher than the interest rate than you're receiving on your cash, you are losing.
Mm-hmm.
That's that purchasing power risk that we were talking about. And if you're just keeping pace with inflation, some people are okay with that, but most people are in a place where they can take more risk than just matching inflation. When we talk about risk, it's a need, willingness, and ability. A lot of people don't need to take a whole lot of risk. But if you don't have a need to take a whole lot of risk, you have an ability that you can take some risk. So let's find a good balance in the middle there, where you're growing your assets, maybe for legacy planning, your kids, a charity, whatever that may be. But let's take on some risk here and try to grow some assets for you and beat inflation, because everyone likes to make money, and if you can take on slightly higher risk and still do that, beat inflation, it's a win-win, and it creates more diversification for you.
So if you're somebody who's listening and you consider yourself a conservative investor, maybe you're in all cash and you're suddenly hearing some things that are, ringing true. You're concerned about inflation. You're concerned about rising costs, and you're not making any money on your money. You need a partner. This can be very overwhelming, and there's no two ways about that for everyone. The Haven Financial Group, they are there for you. They're there to help put together a portfolio, even for a conservative investor, so that retirement is everything you want it to be. Give them a call, 612-504-8400. Again, 612-504-8400. Call the Haven Financial Group today. Give them a call. Tell them you've heard us here on the radio and that you're looking to come in and to talk a little bit about your investments and what the future may hold. Gentlemen, when we come back, let's talk about, let's see here, what's in the president's new tax bill. That's coming up right here on the Haven Financial Group Radio Show.